But I love gold. It started the year very strongly, rising 13% from January until mid-March. But since then, gold, as you know, has plummeted, falling to its lowest level in 8 months. So maybe now's the time to buy, or is gold set for yet another sell-off? Time for a street fight. For the Bulls, we have Peter Schiff, Euro Pacific Capital CEO, and for the Bears, James Cordier. He is OptionSellers.com founder. Gentlemen, thank you very much for coming in. Peter, first to you. Now, most traders will tell you that as the dollar strengthens and as the Fed gets prepared to raise rates, the price of gold is going to continue to sink, to which you say what?
Well, I don't think the Fed is actually going to raise rates. I agree that there are a lot of people who believe that a rate hike is coming. But I think before that considerable period of time comes to an end, the Fed is actually going to launch another round of QE that is even bigger than the one they just tapered. Because I think that the Fed has misjudged the strength of the U.S. economy, and I think we're going to be back in recession before the Fed begins to hike rates.
Well, before you go into the recession, let me just ask you, this is news. Hold on a second, Peter.
QE mode.
This is news to a lot of people that the Fed is actually contemplating a new QE that is more intensive than the ones that we've seen in the past. Do you have any information, or is this just a guess on your part?
Well, remember, every time the Fed has done QE, whether it was the first QE, QE2, every time they've launched QE, they've always followed it up by another one. They've never claimed that they were going to do it. Everybody thought, well, they're going to do QE and then the economy will recover. They'll be able to raise rates. They've never followed QE with a rate hike. They've always followed it with a bigger dose because it doesn't work. The more you stimulate an economy with QE, the more addicted it becomes to it. And when you take it away, you get a withdrawal, and then the Fed comes right back with more. Remember, Janet Yellen said it's all data dependent. And so if the economy rolls over, she's back in the QE business, and the rate hikes are off the table.
James, have you heard anything, because I haven't, about this new QE that Peter thinks is going to happen?
Well, that would actually be news to me and probably just about every other investor. Quantitative easing, as far as we know, will end in the next year or two. Interest rates are going to bump up ever so slightly next year. And with the European Union still contemplating lower interest rates there, that should continue a strong dollar and make it a very difficult landscape for gold going forward.
And, James, we also have the problem that you alluded to of the weakening of both Europe and we haven't talked about China. It does appear, and we just had new information out today, strengthening the notion that China is weakening a little. Won't that also increase the upward pressure of dollar and therefore the lower price pressure on gold?
Right now is the perfect storm against gold. We have a weakening Chinese economy as well as the European economy, so demand is certainly slowing because of that. As they weaken, the U.S. economy and its dollar strengthens versus those two economies, causing gold in real terms to be more expensive, and that's why you don't see Chinese buying coming in at these prices just a little over $1,200. In real terms, gold's still around $1,250, $1,275 for these foreign countries, and that's why it's not really a bargain, and you don't see them coming back in the market.
To which Peter says what?
Well, I think from the dollar price perspective, there is a lot of support around this 1,200 level and even a bit below. So I think there's going to be a lot of buying down here, and you usually get a lot of bearishness when gold gets around the 1,200 level. But I don't know how you could be, if you're so bearish on the global economy and you believe the Fed is going to tighten and ultimately shrink its balance sheet, which is something the Fed has never done really in its history. The balance sheet always expands. So we're about to have a tight monetary policy, and we're going to have a weak global economy. How is the U.S. economy in isolation going to withstand this? How is the U.S. not going to roll over into recession
if you believe that's going to happen? And it takes a while for Peter to hear me. But, James, how would you answer that question? How does the U.S. economy in light of the weakness from China and Europe?
Everything is relative when it comes to the value of currencies. If the United States economy is this much stronger than everyone else, the U.S. Currency continues to strengthen. As long as that happens, it doesn't matter if the world economy is strengthening as a whole or if the United States is just slightly. The greenback continues to be strong. Demand for gold is calm at that point. And as long as that environment takes place, a sustained rally back to 1350 or 1375 is very
But
unlikely.
if interest rates are rising, the U.S. economy can't be strong. If interest rates are going to rise here, we're going to be in a bear market in stocks. We're going to be in a bear market in real estate. Consumers are going to be crushed underneath the mountain of debt. The U.S. government's going to have to deal with a huge debt service payment, either with much higher taxes or big cuts to government spending. I don't see how the bubble economy that we've inflated, that is so dependent on cheap money, how does it survive the removal of that cheap money?
James Cordier, I'm going to have to give you the first word the next time we have you guys on because we have literally run out of time. I'm so sorry. Thank you. We could continue this for a while. Peter Schiff, James Cordier, thank you very much, gentlemen. By the way, we want to hear from you folks. Will the gold sell-off continue, or is now the time to buy? Send us a message, facebook.com/afterthebell. Your answer is coming up. Cheryl?
Peter Schiff. Tell you, tough guy. All right.